Today, we would like to talk about China's coordinated monetary and fiscal response. In yesterday's morning market video, we covered the fiscal stimulus used by China, and this morning they've also looked to drop interest rates to coordinate both monetary and fiscal policy together to try and get a better response to combat slowing GDP growth in China. We think it's also important, however, to just provide some details in terms of why GDP growth in China has been slowing. So, as we know, during the COVID-19 lockdowns, we saw Western consumers shift some of their spending from services, because they were no longer available, towards the goods sector. And China, being one of the largest exporters of goods on the planet, was one of the main beneficiaries of this trend. We also know that China was slower in unlocking its economy compared to places like Europe, the UK and the US, just due to the weaker or less efficient vaccines that they were using. We also know, however, in 2021 though, some of the government regulations on the tech sector, education sector, but also most importantly, the real estate sector has also weakened GDP growth. The government wanted to try and reduce the amount of leverage within the real estate sector, and that has had a knock-on impact in terms of GDP growth, given that the real estate sector makes up about 1/3 of GDP growth within China. So what we've saw from the Chinese authorities is, as we covered yesterday, fiscal stimulus, about 140 billions worth, but also what they've done this morning from the PBOC, so the Chinese central bank, is reduce interest rates by 0.3%. Now, 0.3% doesn't seem like a large move, but that's the largest move that they've made on record. So we're really starting to see monetary policy and also fiscal policy work in hand to try and increase consumer sentiment and also look to increase GDP growth within China. Now, ultimately, what does this mean for markets? Fixed income markets haven't really reacted to the news. That's probably because interest rates have come down despite the fiscal spending moving higher, but it's really within equity markets that we've seen the main move. We know that valuations on Chinese equities have been low as investor sentiment has been low, and that has meant that Chinese equities are up about 7% in September due to these moves. So thank you for watching today's video, and we'll catch you in tomorrow's episode.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.